Welcome to Set Up for Success, the mini course where UK solopreneurs build solid foundations so they can spend less time on admin and more time on growth. So before we start off, just a quick reminder that this is educational content only. It doesn't substitute professional advice, and you should seek the advice of an accountant for your specific circumstances if you require more detailed information. But if you're ready to get a basic understanding and set up for success, then I highly recommend that you continue to watch this mini course series. So first things first, there are different legal structures within the UK when it comes to having a business and having trade. Most people, when they pick which legal structure they fall into, are going to either pick a sole trader or a limited liability company. Now, these two structures have a significant impact on a number of things that you will need to take into account when you're selecting between the two. These are liability, taxes, administration, potentially public perception, and how you eventually pay yourself. Now, before we get ahead of ourselves, let's talk about what a sole trader actually is and what a limited company actually is. So firstly, what is a sole trader? Well, a sole trader is someone who is running a business or has business trade and it is in their personal name. Effectively, there is no legal separation between their personal assets and the assets of the business. On the other hand, when you have a limited company, you'll have the company here, and that company will have its own assets, own trade, income, expenses, etc. And then you will have the owners. The owners in this instance are called shareholders, and you could have one shareholder, you could have 2, 3, 4, 5, 6. It really is dependent on your company's ownership structure. But the difference here between a sole trader and a limited company structure is that all of the owners, the shareholders in this instance, have a legal separation between their personal assets and the business assets. Now, you can see here where it could have a knock-on effect on liability. If, for example, you are a sole trader, so we've got sole trader A who performs massage services to individuals. And say, for example, sole trader A performs a massage and injury happens as a result of that massage. Now, their client could choose to take them to court. And what happens there is a risk that the assets of the individual could be taken as compensation for that client if they are found to be at fault. Now, the assets when it comes to a sole trader is not just the business assets, it would also be their personal assets as well. Now, in contrast, if we look at that same example, but for a company, company A is owned by person A, who is the only shareholder. So they own 100% of the company. But person A has basically set up a company in order to run massage services. The same thing happens. There is some kind of issue. They potentially cause injury. They're taken to court by the client. The only assets that would be at risk would be that of the company, as opposed to the personal assets of the individual. So in different circumstances, depending on the details of the case, there may be some variation and some differences. But in the wide scope of things, this is the main difference when it comes to liability between that of a sole trader and that of a company. Now, the taxes that each of these different structures pay is also slightly different. If you are a sole trader, you will be paying income tax on all of your taxable profits. So what does that look like? If you're making turnover of 100,000 and then you have allowable business expenses of say 50,000, you will then have taxable profit of £50,000. That means you would then pay income tax on that £50,000. Now, currently in the UK, personal allowance is £12,570, which means that you would have a tax-free amount of £12,570. The remainder of that 50,000 would have income tax due on it of 20%. Now, that's what the tax setup is when it comes to being a sole trader. So the key difference here is that there's slightly more flexibility when it comes to limited companies. There are different taxes to take into account. The company itself pays corporation tax on profits. The individual, so you, if you own the business as well as work within the business, you will pay different forms of tax. So as an owner, if you want to withdraw any money from the business, you would have to pay dividend tax. But something to be mindful of is that you can only take dividends after you have paid corporation tax. So let's use some figures as an example. The company makes £100,000 in turnover. It then has expenses of £50,000. There is £50,000 worth of profits that the company has to pay corporation tax on. Now, corporation tax currently is at 25%. So you do have a small profits threshold, which means if your profit is £50,000 or less, you would only pay 19% corporation tax. Between 50,000 and 250,000, you would pay an adjusted amount, and anything above £250,000, you'd pay 25% corporation tax. So now we have that cleared up. Your company is going to pay corporation tax on your profit. So if we take 19% of £50,000, need to get my calculator for this one, we are left with £40,500. After we've paid our tax, we can then choose to withdraw dividends. So this is if you're an owner only, and you would pay tax based on the dividend tax rate. I'll put a link in the workbook so you can see the different rates and thresholds, but these are lower than that of the income tax rates. So that's something to bear in mind. But also to bear in mind, corporation tax has already been paid on your business profits. So each individual case is different. So say you're setting up your limited company for your solopreneur business. In this instance, you are going to be the owner and you're also going to be the person who works within the business. So if you're paying yourself a salary, you would have to pay income tax on that salary. The difference is that doesn't come out after you've paid corporation tax, that would come out before. So that would be included in the expenses of the business. So remember we gave the example, you made £100,000 in turnover and then you had expenses of £50,000. Your salary would be included in that £50,000. And then you would be paying income tax personally on that salary. So think about it this way. When you was working your 9 to 5, you received a salary from your company, and on your payslip, you would see things come out like national insurance, you would see income tax, maybe you would even see student loan. When you are working within your own solopreneur business and you're taking a salary, that's exactly what's going to happen there. That's exactly what you're going to see. But it's going to be an expense of your company, so it will be included in that expenses line, and then you would have your business profits. After you've paid corporation tax on your business profits, you would then, as the owner, be able to take further dividends from your business and then pay dividend tax. Now, like I said, I'm going to include all of the different tax rates so you'll be able to see the differences. But just remember, there is more at play when you set up as a limited company when it comes to tax. Okay, so we've discussed liability and we've discussed taxes. But the next thing we need to talk about is administration, because the way in which you set up these different structures is also different. So as a sole trader, there are some key dates that you need to remember, but there are far more as a limited company. So as a sole trader, let's start with the one that everyone hears about all the time. This is your self-assessment tax return. This is the 31st of January. Everyone hears about this, whether you're self-employed or you're not. So first of all, you have to think of the fact that you have an annual submission to make. Because of making tax digital, this may change to quarterly returns, so that's 4 returns, but that depends on the amount of turnover that you make in a given year. Currently, we also have something called payments on account. Now, payments on account means that you make one submission, but there are several payments to make during the year. That's also something to take into account, but all of that would be dependent on your turnover or your profits. You would also, at the initial stage, need to register with HMRC, which we will discuss later on in this mini course. And then after that, you would be set up. You would have your self-assessments, potentially quarterly returns, potentially payments on account. But that's about it. That's why becoming a sole trader is often seen as a more simple method of starting a business in the UK. In contrast, you then have all of the administration that is required for a limited company. Now, as an auditor, I'm au fait with some of these because we had to audit accounts and then obviously we had to look at confirmation statements, etc. But firstly, you have to register with Companies House. Register your business with Companies House either as a limited liability partnership, a limited company, etc. There are so many different formats. Like I said, we're only going to be talking about limited companies. You also have to file annual accounts. Now, you have to file accounts once a year. There are specific time frames that you have to do that within, but that is something that we'll discuss in a later portion of this mini course. You then have to submit corporation tax returns. That has to be done once a year also. You also then file confirmation statements annually, and these are to tell companies house whether there's been any changes in your business structure, in your shares, etc. Now, some people think that there is a public perception difference when it comes to being a sole trader, so self-employed as an individual, or having a company. So this is highly dependent on the individual and your circumstances as well. It is something to take into account, but it isn't something that you should base your entire decision upon. So just bear in mind there may be some public perception differences, but this isn't something that should deter you from doing one or the other. Finally, the way you pay yourself is different in the two structures, and we've touched upon that already. As a sole trader or someone who is self-employed, you'll have your turnover, then you'll have your expenses, and then your entire business profit will have income tax applied to it. After income tax has been paid, that's what you take home. That's effectively it. That's how simple it is. As opposed to when you have a company. If you are running a solopreneur business, you would be an owner as well as an employee. So as an owner, you would take dividends after corporation tax has been paid on the business profits. And as an employee, you would be paid a salary, and that would be taken into account in your business expenses. So that is the difference in the way in which you pay yourself. So to sum up quickly, there are pros and cons to both of these business structures, and it is highly dependent on which one suits your needs now, but also may suit your needs further along down the line. If we take sole traders, for example, someone who's self-employed, it is quick and easy to set up. There's no need to register a company on Companies House. There is definitely a lower administrative burden. Some people may argue that this is increasing because of making tax digital, which we'll talk about in a later video, but there is still a significantly lower administrative burden. There is simpler tax filing. You have your self-assessments. You can also use the cash basis accounting method, which I haven't actually gone into detail in this video, but there will be a bonus video in the free community just giving you a brief understanding and explanation of the cash basis accounting method to see if it's something that makes more sense to you. And generally, there are lower ongoing business running costs when it comes to being a sole trader. Now, the cons are what puts people off. There is unlimited personal liability. Like we said in that example, if there just so happens to be an issue, this is something that you would be personally culpable for. There are insurances that you can and should put in place to mitigate against this, but the overall structure means that there is potentially unlimited personal liability. Sometimes it may seem less formal to some clients or some investors, but like I mentioned, this shouldn't be something that deters you from picking one structure over the other. One of the biggest things that people say, and I would also state this as well, is that there is a lot less tax flexibility. And when I say tax flexibility, I actually mean tax planning flexibility. We've heard that as a sole trader, you just pay income tax on all of your business profits and that's it. Whereas if you have a company structure, you can structure it in a way where you take a specific salary out of the company, impacting your company's expenses, and then you would take specific dividends out of all of your post-tax profits. So it's very important for you to think about how much tax planning you would want to integrate into your business, or if you're happy to just make a set amount and have all of that taxed via income tax methods. Obviously, the pros of having a company structure is that you have limited liability. That's one of the main pros and perks of having a limited company structure. There is more flexibility when it comes to tax planning, and there is a clear separation between the business and the individual. But the cons for this are just as strong, to be fair. There is a lot of administrative burden. There are a lot of deadlines you need to think of. There is a lot of paperwork that needs to be submitted. You need to stay on top of all of the changes that happen quite regularly. And we're in a time and a season where there's a lot of changes taking place when it comes to the digitalization of information, when it comes to companies, what's available on Companies House, when it comes to director information, etc. So you need to ensure that you are ready and prepared and skilled enough to take on that burden, or you have enough financial backing to be able to pass that over onto an accountant. You will need to have a basic understanding of double entry because, unlike the sole trader or the self employed individual who can use cash basis accounting, you will have to use accruals basis accounting. So you'll either have to get a bookkeeper to do it for you, which is an additional cost, or you have to have a basic understanding of how to do double entry. And something that's not mentioned regularly, but something that is worth noting, is that when you register a company and you put down your information as a director and as a shareholder, your personal information becomes public record. So if you are registering a company at your private address, for example, which a lot of people do, most of us do, especially when you're setting it up by yourself on Companies House, what individuals will be able to see is your name as well as a street address. So it's something to bear in mind when you're actually registering a company on Companies House. You can use what is called company secretarial services, which means that you can pay a company to use their address, and you would register your company with your name but with their mailing address. So in a nutshell, the setup costs are higher and the ongoing costs are a lot higher than being in a sole trader structure. I would highly recommend that you go into the workbook and you start to note down what works for your industry, your circumstances, and also the future plans of your company. One thing to note that a lot of people aren't even aware of is that if you start as a sole trader, you can later incorporate that business into a limited company. So there's flexibility there. You can incorporate into a limited company and you can unincorporate from a limited company. And that allows you to have breathing space. That gives you the opportunity to start the trade, start the business, have lower running costs. And if the business and the trade starts to take off, then incorporating that business into a limited company structure, which then gives you more tax planning flexibility, a potential improvement in your perception as being a professional service provider, etc. So that's definitely something for you to think about if you're kind of on the fence or you're and ahhing or you're not sure, or you just don't have the funds for the higher setup costs and ongoing costs for a limited company right now. So that's effectively it. The difference between being a sole trader and the difference between a company. So if that helped you, I would strongly recommend that you watch the next video, which is about your business names. Things that people don't think about and names that just aren't allowed in the UK, but you didn't realize that was a thing. So click to watch that next one.